Did I just mess that up?
Oh, you just started the broadcast. That's fine. We'll be a little bit early. Bear with us, some attendees that were sitting and waiting. We will start on time. Oh, there's Pete. I forgot we have videos too. We're pre-gaming and messing it up.
Can you guys see me?
Not yet. You have to turn on your video in the upper left of the control panel.
There we go.
There we are. Hi.
Excellent. So
Pete, can you hear us okay?
I can. I can.
Are you all set with the screen sharing, Maria?
yes, let me try one thing.
There we go. I see a slide deck now with the beautiful Capchase purple. Vaporwave.
Yes.
Non-dilutive financing.
Correct.
All right, folks rolling in, thank you for being early. We will get started shortly. Thanks for bearing with us through setup.
I like that Maria just started the presentation though, really taking over the controls, being like, we're doing a pod.
It's very bold. I like it. Well, I feel like every webinar and video conferencing software is a little bit different. So it's very easy to just accidentally do
There's
things.
play buttons everywhere.
Yes. I started now a little bit early.
That's totally fine.
2 minutes, Barry. I have 8 people in. Yeah, you just want to kick it off at the top of the hour, Pete?
Yeah, I might give people a couple minutes after that to hang in.
What we should start doing is playing music during this part, because I forget who we worked with. I think it was On Deck, maybe?
It's On Deck that does it. It's very soothing.
Yeah.
It's very soothing. It's fancy. It definitely feels and sounds fancy.
And it means that you don't have to sit here and make banter while you wait for people to come in. So it's also pretty nice. I was thinking of it and I was like, I don't have an appropriate song that I can think of off the top of my head to play, so I didn't do it.
Well,
the new War on Drugs record playing in the background would have been totally appropriate.
I was thinking on the On Deck thing, especially because they're getting pretty big. There's definitely licensing issues with that, though. What I would imagine, right? Because you don't own the right to replay your Spotify list. You only own it personally. But like, could you play 10 seconds of a song and then just keep crossfading into another track and it wouldn't trigger?
Yeah, I guess technically you are now a performance.
Yes.
I don't know. That's interesting. We'll have to ask an IP lawyer about that.
There we go. Well, we have an IP event coming up in 2 weeks.
Is that right?
Yeah, with a IP specialist law firm that's actually in our launch network, which I now reminded I need to get the invites out for.
Yeah.
Always something.
There's always something to do. It happens to me in the middle of the night, like the moments that when you're relaxing the most, and that's when like the reminders start kicking in and then you're no longer relaxed.
Yeah, startups are really fun, right?
Oh, yes. I mean, it happens to me all the time. It's like you always finish your day with like a ton of pending things. Like there's never, I started actually my career in sales and trading. So when the market closes and you finish your book, like there's nothing you can do. So you would actually go home and it was great, And now it's like you never finish your to-do list, and it tends to grow at a faster pace than you actually can cross it. So yeah, that's the description of the startup life.
Browser tabs and to-do list items and to-do lists themselves.
Yes.
It's pretty funny. All right, top of the hour, we've got 19 folks in. I'll give a few more minutes just for people to trickle in. Usually folks are somewhere between 2 and 5 minutes late. Thank you to all of you who are actually on time. We do really appreciate it. It is helpful.
Very helpful.
Typically punctual.
All right, and some familiar names in there too, which is always nice to see. All right, I'll
That's
do
fine.
3:03, so it's not an unbearable amount of time for us to sit here and just wait and watch.
It'd be great if people can drop in the chat where they're logging in from, say hi.
Oh yeah. So yeah, both the chat and there's a separate chat as well as a Q&A, but we got some people from LA. Pete, even though he's speaking, he types showing a good example.
Leading by example, it's important.
From Highlands, New Jersey, recently moved. Hello.
Oh, that's me.
Well, that's the other fun thing about different webinar tools too, is that the chat is always completely different.
Yes, very much so. We actually just started with Hopin. Let's see how that one does.
Ah,
Yeah, let us know, because we're always looking for ones that have decent UX. Or actually, we're looking for ones that have phenomenal UX to make our lives easier. But what we typically
Yes.
find is ones with decent UX.
Yes.
All right,
Yes,
we're at
so
3:02 now. So very
Excellent.
shortly, we will actually kick things off. All right, and we've hit 3:03. Thanks everybody for being here and being mostly on time or very close to it. Super excited for today's presentation with Maria Pareto from Capchase. As you all probably know, raising money from investors through the typical venture trajectory is really, really difficult. It takes a lot of time. It takes a lot of connections. The success rate is very low. So we're super excited to learn more today about what Capchase is doing around non-dilutive capital for growth stage companies. And you may be seeing a lot more of this out there today, just around different financing options for companies that have revenue or that have assets. Lots of exciting stuff that's happening. So I will kick it off to Maria to take us through. We'll run through this. If you do have questions, please ask them in the chat or the questions box as we go. We'll kick them in if they're super topical or important. Otherwise, we will loop back and grab them all at the end. All right, over to you, Maria. Thanks for being here.
Thank you, Peter. Can you guys see my screen?
We can.
Excellent. Thank you so much for that introduction. Super exciting topic. First of all, I'd like to introduce myself. I'm a partnerships lead here at Capchase. We provide revenue financing to recurring revenue businesses. We'll get into that in a little bit. Started my career in venture capital. I became too close to the pain points that founders have to raising capital. They tend to be really sophisticated in so many different areas, but fundraising is just one that terrifies pretty much everyone. So last year, when I started seeing the rise of alternative forms of financing and the pain point that they were solving, I decided to jump in and I joined Capchase about 6 months ago, and it's been really a fascinating experience. So during this talk, I will talk a little bit about raising capital as a startup, the traditional forms of raising capital, which tends to be equity and venture debt. And then we'll jump into revenue financing, where it fits within all the different options that startups have and how you can take advantage of it. So let's just jump right in. So raising capital as a startup. So first of all, like why startups raise capital in the first place, right? And really at the beginning, there's a lot of sunk costs that most startups need to do, right? From like building your first product to then launching it. And then once you launch it, like acquiring your first users. And usually startups these days have subscriptions, right? So customers pay monthly and that revenue doesn't come in for a long period of time. So of course, raising capital, it really allows you to bridge that gap between like all these upfront costs and then collecting that revenue, throughout the lifetime of the customer. So here in this screen, right, we can see the different types of raisings that startups do, from idea and concept, starting from bootstrapping, friends and family, then joining an accelerator, starting receiving capital from business angels, and then later on raising capital from venture funds and banks. This is historically what has been all the way to becoming profitable. I want to focus our conversation mostly on these two because they're the most popular one, VC and banks, and we'll talk about like what's good about them, what's not great about them, and then we'll talk all about revenue financing. We summarize it in RevFi. So if I say RevFi, I apologize. I live too much within our acronyms. And where does revenue financing fit in within those two? So first of all, let's talk about venture capital. Most of you are likely like super familiar with the model, so I won't go too deep into it. But really, money is the least important thing that they bring. They can become incredibly valuable at the beginning of the life of a startup, right? They can help early on before having traction, building your MVP, hiring that key talent at first that will be crucial to build, your first product. Find product market fit, and then they become really like a great source of capital for future funding rounds. So really they can become extremely valuable at the early phases of your startup. Because they take so much risk, is the most expensive source of capital that you will likely take, right? And here in this slide, we can see the evolution of ownership in startups across different funding rounds from inception all the way to Series D. And we can see that the average founder ownership decreases to nearly 10% at the later stages. Sure, the pie is getting bigger every time, but for like a 10% ownership is incredibly low for all the time and effort that founders tend to put in. And now actually there's so many different forms of financing where you can still grow the pie and scale your company without necessarily like diluting yourself so much. Not to say that it's incredibly time consuming. Most of you will know, right? There's this study by Y Combinator that says that it takes over 30 meetings to get a term sheet. And this is the companies that actually get a term sheet, right? We're not talking about the ones that don't. So from 30 coffee meetings, 50% will lead to a single partner pitch. 30% of those will lead to a full partner, the full partner with a partnership within a fund and introducing your company to all of them. And then 1 in 5 will actually lead to a term sheet. So it's an incredibly time-consuming process for the leadership team of your startup. And if you actually think about it, it's incredibly expensive, right? Because if let's say that you raise $10 million in a Series A at 50 million valuation, you're selling 20% of your business. When your company becomes worth 200 million, that piece that you sold is now worth 40 million. So really VC, while incredibly valuable in the beginning, can become a pretty expensive source of capital later on. Then there's venture debt, right? It's an alternative to venture capital. Startups are able to access venture debt once they have raised a VC round in the past. It's typically used to complement an equity round and is provided by banks which specialize in venture debt. Terms is usually 3 to 4 years, and amount lent is around 30% of the total amount raised in the previous equity round. Unlike traditional banks, venture debt does not require any form of collateral because startups, at the end of the day, they don't have any collateral. But instead, these banks tend to be compensated via warrants, which a lot of founders actually don't understand what that is. And basically what that is, it tends to be 5 to 20%. It's usually 5 to 20% of the principal amount of the loan, which could convert into equity later on, which could, again, get super expensive very quickly. And then the other thing about venture debt is the covenants. The covenants tend to be pretty stringent and also something that a lot of founders are not very familiar with, but it's basically terms and if your company does not meet certain KPIs, the lender can come in and increase your rate, limit your credit, and in the worst case scenario, like recall the loan. If you meet those KPIs, that shouldn't be triggered, but it's also like something that could happen. And it's something that worries a lot of founders. Truth is, it's also a great non-dilutive source of capital and a good alternative to VC. It's a process that it's pretty long. It takes 1 to 2 months to close a deal with exhaustive diligence. Again, it has pretty stringent requirements in the form of covenants, security interest, and then after it's implemented, there's pretty ongoing diligence and reporting, which which is not the most user-friendly. And then the third one is, this happens a lot where there's a lot of fine print in these contracts, where there's a lot of hidden fees around, repayment, administrative fees, legal fees, closing costs that, you don't realize until much, much later on, which is not a great experience either. So in conclusion, founders spend a lot of time in fundraising, only to face like dilution or hostile debt terms. And our founders at Capchase, they used to work at a SaaS company before, and they experienced this firsthand, right? Like they were in a SaaS company, they were seeing that their customers wanted to pay monthly, and they were incurring a lot of upfront costs to close every single customer, whether it's like implementation and acquisition costs, and then after that, servicing the customer, and they were not actually breaking even on that customer until month 7. And even if the company wanted to start charging upfront to make money on that customer on day 1, these customers, if charged upfront, would require a discount, right? So ACV would be lower, the growth rate would not be as interesting. So that was like there's a lot of friction in a pretty big pain point. So they decided to actually leave and then launch their own company and launch Capchase. So really, Capchase started with the premise and the belief that the greatest asset of a recurring revenue business, which is most startups, is their recurring revenue. Right in the balance sheet, you can see your cash, you can see deferred revenues, which is the subscriptions that are yet to come. And that at the end of the day, that's an asset, right? So in reality, you can convert those assets into cash to grow today. And that really is revenue financing, right? Like revenue financing at the end of the day is it's becoming a more efficient and non-dilutive way to grow your startup, right? So really, what is it? Really, revenue financing, what it is it allows you to transform future revenue into upfront capital to fund your growth without any dilution or any debt, right? It essentially is allowing your SaaS or your recurring revenue business to accelerate up to 12 months of future cash flow into day 1 cash, right? Turning future ARR into present day resources. And what you can do with these resources, right? Like you can reinvest it in your business, accelerate growth, preserve your equity at the end of the day, and then extend your runway at the same time. So how does revenue financing actually work? So this is how we do it at Capchase. So basically you come to Capchase, you connect your data via our integration. So you connect your banking data, your accounting data, and your revenue data, mostly your subscription data. And then underwriting, like we'll look at your data in a very automated way and then come back with a financing offer within 24 to 48 hours. Usually financing offers will be between 30 to 60% of your future ARR. And once approved, let's say like you receive a funding offer within 24 to 48 hours, you can basically tap into those funds immediately. So we'll take a look at what that exactly really looks like. So what's different about revenue financing that we don't see in equity or debt is that it's funding that automatically grows as you grow, right? Normally with equity or debt, you get an upfront amount that you can tap into today, right? And you pay for that upfront with Capchase. The great thing is, let's say that you are a 1 million ARR business today. Capchase gives you available capital of 60% of that. So let's say 600K. If you grow to 2 million ARR in 6 months, your available capital will also grow 2x to 1.2 million, right? So every 30 days, automatically your available capital will grow. So you don't have to go back, in VCs, like raise capital again, or you don't have to go to your bank to ask for an increase of your line. Like this is automatically done, happening behind the scenes. So your available capital grows as you grow. In terms of flexibility, this, the flexibility that you would get via revenue financing actually allows you to be much more cost effective on these funds. Again, this is what happens when you raise equity or the typical term loan. With revenue financing, you can actually, let's say you get access, as I was saying earlier, 600,000 of your ARR, you can access into capital today, but let's say you only need 50,000 this month, you only use 50,000, the next month you can use less and more, depends on your needs. You can tap into whatever your business needs and only pay for what you use. So that, you know, really allows to really optimize the cost of financing. The third one is like the cost is actually like pretty simple. There's really no surprises here, no hidden costs, no covenants, no warrants, no security interest. Like the revenue financing at Capchase, really we only charge a fee up front. So in this case, we're looking at a company that is taking $1 million. The fee is 86,000, right? So the company is going to take $1 million today and then pay back the full principal plus the interest, which is $1 million and 86,000, divided into 12 equal monthly installments, which is 90K every month. And that's really as simple as it is. It's really no complicated than that. So it's really meant to be like super transparent for the company. And of course, much cheaper than equity or debt. So what are the metrics really that we look at or really move the needle when you want to access your future revenues, right? Of course, revenue growth is a really important one. The faster your revenue growth, the more available capital that you will be able to access. The higher the LTV, the better, because the more capital that you put into your business, the more it's going to yield. So we always look for high LTV to CAC businesses. Gross margin, the same thing. The higher the gross margin, the more capital you'll access. That's just because there's more cash flow going into your business. And lastly, churn and retention. Of course, we provide more capital to those businesses that have high retention, because if you're putting a lot of capital into your business and then you're losing it, there's not that much value that you can really bring forward into the present. These are actually like fairly similar to the KPIs that a traditional VC will really look at. Now let's actually look at some use cases and case studies, like what do companies use revenue financing for? And I'm actually going to talk about some specific case studies of companies in our portfolio that have used it for these specific purposes. So these really are the 6 main use cases for revenue financing. So the first one is user acquisition for growth, mostly via paid marketing. Facebook ads, Google ads, really just injecting capital into your growth engine so you can grow faster. The second one is large expenses. There's always like these large chunky expenses, whether they're annual SaaS bills, whether it's like AWS or GCP, and those tend to be like pretty impactful to your cash flow. So with Capchase, you can basically like use revenue financing to smooth those out and really spread them out over time. The third one is M&A. This is one that a lot of people actually are not very familiar with, but a lot of companies are coming to Capchase to finance mergers and acquisitions, and we'll dive deeper into a company that's actually doing that every quarter with Capchase. The fourth one is hiring for growth. These tends to be mostly sales and marketing hires, but at the end of the day, the great thing about revenue financing is you can basically raise the capital and use it for anything that you would want. So the use of proceeds is really up to the company. There's no specific ties to what each dollar goes to. But really what we see, and specifically for hiring for growth, we see a lot of sales and marketing hires. And really the fifth one is a cash flow gap. So really using revenue financing to either for working capital or really like smoothing out specific cash flow gaps that your business may have, whether it's seasonality or anything of the likes. And here we can look at very specific case studies, right? This was, in this case, we have a consumer fintech startup. They started, working at Capchase when they had 80K in ARR last year. They were struggling to get the money to grow. They were not burning a lot of money, but they were pretty unfundable at that point. They came to Capchase, they connected their data, and automatically they saw that they could tap into 40% of their ARR. They brought in 30K and they put that into Facebook ads and Google ads, and they grew their ARR from 80K to 120K. And then next week they continued doing it, and then again, and again, until they now have an ARR of 10 million that they have this past month. Their LTV to CAC was really high, so this was a business decision that made so much sense. You know, can you imagine like going to VCs or to your bank like every week to get more capital? Like that likely would be impossible. But because they were able to tap into you know, capital in a very much on-demand way and have this credit line automatically grow as they grow, they were able to just use it like very programmatically. So this has been like a pretty incredible growth story. This second case study is the M&A, which I was talking about earlier. This is a recurring revenue marketing agency. They have a lot of customers on retainer. They came to Capchase to acquire smaller companies and in basically like growing part of their revenue in an inorganic way. But you know, there were a lot of synergies as this business could have. So basically, how this works is, when you want to acquire a business, you can use that business's future revenue to bring that into the present, and then use those funds to actually acquire the business. So imagine they want to buy a company that has 1 million in ARR, and the price, let's say it's 2 million. They can accelerate those revenues, all those future cash flows for the acquisition, and then use that, you know, to buy that specific company. So they're buying one company per quarter. So they actually just completed 2 acquisitions via Capchase, and essentially they're doing it. You know, you could justify that they're doing it for free, right? It's essentially the same way as in real estate, you know, where a company can use rental money to pay for the mortgage. So it really is an incredible story. And the more companies that they acquire, right, the higher the ARR the overall parent company has. So also the credit availability increases, enabling, you know, the Capchase client to keep tapping into that capital for growth. And the third case study is revenue financing for large expenses I was talking about earlier. This was a bootstrap company. They were super diligent with their cash. That means like they didn't have like any large cash balances at any point in time. Some of they looked at their pipeline and they saw that many of their prospects in the pipeline would require SOC 2. They didn't have that, and they realized that it would take them actually over 300,000 in engineering resources to complete that certification. It's a pretty stringent data compliance certification. So they came to Capchase, they tapped into, you know, those 300,000 to finance SOC 2. And they completed it very quickly, and then they were able to close a client, a pretty big, large enterprise client, that they were able to double their ARR overnight. So that was really also a great case study and use case of revenue financing. And in this case, I've been talking about, venture capital. I've been talking about venture debt. Then we dive deeper into revenue financing, what it is, how it works, what is it used for, very specific use cases. But I kind of want to just show you what the platform looks like, because we really pride into making this like an incredible and seamless and in useful experience for the users. So it's super simple to just connect your data, get the offer, and then just draw the funds. So let's just take a look at it.
There's not supposed to be audio from this video, correct?
What's that?
Is there supposed to be audio from the video?
Oh, you're not hearing the audio? Just 1 second.
I'm not.
To share with you our product and onboarding.
There we go.
The dog is narrating. It doesn't seem like anybody can hear the audio, but I don't know if it's absolutely necessary.
Can you hear the audio?
I can't. It was in and out.
We lost it. It might be getting cut out by like a background noise deal.
Oh, yes.
Oh,
Is now better?
No, that's weird. I heard it for a second and then it died.
Yeah,
I
so
think-
basically what just happened now is, the client submitted the draw, the first draw, the rate was 5%. They were able to see, all the future payments that they were going to become due, and that's pretty much it. Like, it's as simple as that. And then you can always log back in and then see all the future payments that are due, but really there's not more science than that. But yeah, I guess the audio has been a little bit funky because I have a loud dog. But thank you so much for bearing with us. And really that's kind of like the click next. There we go. So, always, of course, I can walk you through a very specific product demo one-to-one, but I just want to reiterate that the mission at Capchase is really to put funding on autopilot, enabling via revenue financing, like this ability, so that founders can really keep more of their company, dilute themselves less, and they can really spend less time fundraising and focus more time on building and growing their business, so they can really accelerate that flywheel a lot more. As always, thank you for joining this webinar, wanting to learn more about revenue financing in general. So we wanted to give you an exclusive offer to everybody that attended, and this is basically like a 0.25% off in the rate in your first capital draw, and you can unlock that in capchase.com/partner/Gust. Even if you don't come via this website, but you just want to check it out, and you say that you were in this webinar, or you are a customer of Gust, like we'll give you that perk. So it'll be great to see you come and see where we can help you finance your growth. And something that's great about our company is like it might seem in that video that I just showed like a little bit transactional, but actually like we pair every company to a customer success person, that person really prides in giving white glove service and really becoming a financial advisor and a fundraising advisor to the company. So I would love to help you grow your business. Thank you so much for tuning in, and I would like to open it up for any questions on the information shared and any doubts that you may have on revenue financing and whether it's a good fit for you.
Awesome. We have a few queued up in the questions. The first is from Faruq Hassan. It looks like they're considering doing a crowdfunding and capital raise in 2022, and they're a hardware startup. I think you've answered some of the questions around traction generally, but maybe if you could talk a little bit about where this fits into a company that might do an initial seed stage capital raise, and anything you could say that would be specific, like how might a hardware company mobilize revenue-based financing?
Yes, and actually there are a lot of companies that use revenue financing in a very complementary way to a VC round. So as you know, like there's a lot of companies that raise a round and then they go to venture debt, right? And they kind of complement equity with debt capital. We're seeing a lot of companies do that with Capchase as well. So in this case, like, if you want to raise via a crowd fund or you want to raise via a specific VC fund, like a seed stage, and you want to complement that with revenue-based financing, we love that. We actually love to be pretty complementary. In terms of requirements, I briefly mentioned just some high-level metrics that we look at, but we like to look at businesses, one, that have recurring revenue nature, right? Like whether it's hardware or non-hardware. High preference for tech-enabled, but as long as like we can see recurring nature in your revenue, that's fantastic. In terms of metrics and traction, at least 3 months of runway, at least 6 months of recurring revenue history. We like gross margins above 50%, so that's always a huge plus. And that's really pretty much it. It's as simple as that. At least 3 months of runway, at least 6 months of generating revenue, and higher than 50% of gross margin.
Awesome, thank you. And Faruq, if you've got any follow-ons there. I think I see.
Jorge asked a related question of, is it only for reoccurring revenue models? And from what you said, I don't think it's necessarily you have to be a SaaS business, but rather your business metrics demonstrate customers continually buy from you and you have like an LTV. It's not, you don't have to be SaaS to be recurring revenue. You can be transactional, but transactional in the nature that recurs.
Absolutely, yes. So we really focused on recurring revenue, not only SaaS. So we can work with SaaS. We can look at non-SaaS subscription businesses. We love contracted revenue, long-term contracted revenue. Also usage-based, like if you have an API and you get paid by seats and that's reoccurring, like we also like those. So as long as like you have cohorts in your business, like we likely can work with you because your business is recurring in nature. So we are not only limited to SaaS.
Awesome. And let's see, Michael Levins asked, is this similar to PO financing?
Similar to what, sorry?
PO financing, maybe purchase order. Michael, if you're still here, if you want to clarify what you mean by PO.
I believe I guess like not the details of how PO financing, like how it works. It might be a use of proceeds that we've seen our clients use. The great thing about revenue financing, at least with Capchase, is like as long as you meet the criteria of business model and the traction that I was talking just now, the use of proceeds can be anything. The 6 top use of proceeds that I talked about is like the most common ones. But really, it's up to the company to use that capital wherever they find it most impactful in. So we really don't intervene on when you deploy that capital.
And Michael, I unmuted you if you want to add any color to that. You might have to unmute yourself, but I made you so that you can unmute yourself. And he did say yes, purchase order.
Cool. Yeah, I know there are other models like asset-based financing, purchase order-based financing. It looks like Capchase can kind of subsume some of like the large contract-based financing. There are other things that you can leverage creatively as a new business to bring financing into the company. Revenue-based financing is one. If you are looking at others and you have like a large inventory-based business or anything like that, there's a product from the folks at IndieVC called Intro. That does like a whole bunch of education about the other types of non-venture, non-equity based financing.
Yes.
All right, we've got a question about the underwriting, which I think is answered. This is all about your business. It's not about your personal credit worthiness. It is about the metrics that your business is generating. I'm sure you get that question quite a bit, Maria. Anything else you want to add on top of that?
Yes, absolutely. Like we don't run background checks on the founders or put like their own collateral or their own assets like backing these financing at all. Like this is 100% focused on your business and the recurring revenue on your business and your growth and your gross margin. And it's simply on the health of your business. Like really, there's no natural people backing this financing.
Cool. And this next one is kind of related. It's a question about whether the underwriting model is different for B2B to B2C. I'll let you field it as the expert.
Yeah. So the underwriting does not perform like a different process, whether you're B2B or B2C. Of course, B2B tends to have like a specific set of metrics that underwriting models love, right? Like, it's high retention, low churn, longer term contracts. So that like B2B tends to have specific metrics that underwriting loves. But we've seen very strong B2C businesses that have like very strong metrics as well that completely, pass the underwriting without a hiccup. So we apply the same process, but we tend to, by just looking at the metrics, be able to tell quickly, like, okay, this is a B2B or this is a B2C.
Yeah, so you could probably back predict based on what the algorithm does, but it is agnostic to the actual type
Exactly.
of business,
That's
which
correct.
I think is really great about this type of financing, because it's all about what you can do with your business. If you can get, B2B style revenue growth and retention with a B2C model, then you're not going to be artificially limited by your business model or your market, which is really awesome.
Yeah, and the growth of B2C is fantastic, right? Like B2B might grow a little bit slower than B2C. And even though their churn and the retention might be different, they all, like, if both of them have a pretty healthy business, we love both.
Awesome. And this one, it looks like is about kind of checkups and how the model is adjusted over time. But just a question for new companies with kind of uncertain future revenue, how does it work? I think you answered a little bit with, you need 3 months of runway and a 6-month history, but how does it actually change over time, your kind of credit limit and stuff like that?
Yeah, so the algorithm's job is to predict your future revenue based on past performance. That's why it's a little bit innovative in a way that it's like, it will be 60, we tend to give capital from 30 to 60% of your forward-looking ARR. We leave it to our algorithms to really do the job of predicting future revenues. And again, that's just basically extrapolated from your past performance. The more data that we have and the more history that we have, the higher the capital amount that we will give you, right? So like when it's a business that has been operating for a long time, like really healthy metrics, like we could give up to 12 months of future ARR in capital today. If it's harder to predict, then you have less history, we might be looking at giving you, 30% of your forward-looking ARR, right? But like as you grow, like we've seen in those case studies that I was showing you, that consumer fintech company started, just drawing $30,000, and now they're drawing millions every week, and they were able to scale with us. So, it's fine to start small and see the flywheel accelerate until you really get to the higher volume amount.
Awesome. And how does it adjust over time? Is the algorithm looking at it on like a month-to-month basis? How often is it adjusted, and what does that do to kind of the balance that you already have, if anything?
Yes, so we run an automated re-underwriting every 30 days, right? So when you connect to Capchase, and of course, like, the first thing that happens, sign an NDA, and this data is shared like very securely, but we're connected to your banking data, to your accounting data, and then your subscription data. And then every 30 days, like this re-underwriting runs again. And then if you've grown your revenue by 20%, your available credit cap, which is what we call it, which is your available capital, will increase hand in hand. And if your revenue, of course, drops significantly month to month, you will also see your available credit also decrease, but it will not affect the amount of financing that you have already taken.
Cool. And any effects on the interest rate? Is it variable or fixed, and does it change based on that re-underwriting?
It doesn't fluctuate much, and this is where it's fixed, right? Unless we see a drastic change in your business, which usually doesn't happen, right? Like we're working with a lot of recurring revenue and SaaS businesses that in 12 months, like their business doesn't change dramatically. So we haven't had an instance where the rate significantly changes. Where we're different versus other players out there is how we actually fund these companies, right? We have a dedicated credit facility that we take all this capital from and then lend it to companies. This credit facility, like, we know what the cost of capital is, and this is why, like, we're very, we know what the pricing will be for you for the foreseeable future. Some of our competitors, they operate more in like a marketplace model where they cannot really control that cost of financing. In our case, like, we have a pretty strong view on like what our cost is today and what our cost will be in the 6 months. And unless your business doesn't have a huge 30 and 160 degree change, like, your rate should not change.
Awesome, that's a great advantage. Okay, is Capchase available for South African founders or just US formed businesses, or where can you be formed in order to access the Capchase capital?
Yes, so we are able to work with companies incorporated in the US, in Canada, in the UK, in Spain, and very soon in other countries in Europe. If you're in South Africa and you're incorporated in any of the countries that I mentioned, like, we can definitely work with you. We're working on expanding that more, but yeah, you would have to be incorporated in the US, Canada, Spain, or the UK.
Awesome. All right. How does the capital show up on the company's balance sheet?
Yes, it shows up as like deferred liability, right? So because at the end of the day, you took this capital that you owe back to Capchase. So and I say this at the same time saying that we're not accountants, and I have to say that beforehand. So you will always have to go and talk to your accountant to verify that, where this belongs. But most of our customers have this as like deferred liability in their balance sheet.
Okay.
And thank you so much for reading these questions, because I actually cannot see them.
Yeah, they're interesting to find. Okay, let's see.
You looking for another question?
I have found Calvin's, which I think is very interesting, but I think probably rather in depth. And we have a few, I think, well, a couple that are related from Faruq. Is there a sweet spot or maximum exposure you're willing to take? I think you've kind of answered that in terms of like what percentage of future ARR you'll be willing to lend, but anything else that you want to say on that?
Yes, so usually is between 30 to 60% of your ARR that will give you an available capital. In terms of amount, like, I mean, we have clients that are as little as 100K in ARR, and we have customers that are over 100 million in annual recurring revenue. So we can really operate across the spectrum. The bigger the company, the more capital, of course, that we're willing to lend. So we can go up to 12 months. And the terms, I've been talking about just 12-month repayment terms, but with larger companies with more history, we have gone up to 24 months. So we can, the terms, of course, get better and more flexible the larger the company is.
Awesome. And last one before we get into the complicated one, which will probably take us through the end. What accounting systems and other CRM or data systems do you need the business to be using to have the data ingested?
Yes, so there's only 3 data sources. So there's banking, which gets connected to us via Plaid. So that's most of the banking, platforms in the world. So we have all the banks really there. Then for accounting, it's, the main ones: QuickBooks, Xero, NetSuite, Sage, FreshBooks. All the main ones are there. And then the third one, which is your subscription/revenue data, tends to be Recurly, Profitwell, ChargeBee, all of these ones. Now, that's to say, if you don't have any of these, or you use like an accountant separately, or you don't have a subscription management platform, we have some clients that sends us things via exports, like Excel exports. When that happens, like, which we're totally comfortable with, the underwriting might not be in 24 hours or 48 hours. It might take like 4 days. 3 to 4 days, but we can totally operate with Excel exports.
Awesome. All right, and then into, well, let's see. Do you work with LLCs or just corporations?
Both.
All right, awesome. And then I think our last interesting and potentially complicated one, can you describe a worst case scenario for the lender? What are the typical risks, problems that occur with this type of financing, and what is your recourse?
That's a fantastic question because we're non-recourse. So that's a very simple question to answer. So we're non-recourse, and if something goes wrong with the company, like we would be the last ones to collect. That's the short answer. The more long answer, like what happens when a company is having problems to repay, we do, payment plans. If you cannot meet, the preset payment plan that was set up based on the contract, like we might give you a little bit more flexibility, extend the payment terms. We do that. We have done that, and that has actually worked well. And if a company is not able to pay back, again, like from a legal standpoint, like we cannot do much. But that's why we're also able to be very flexible with the companies that we work with. That's why we're very founder friendly. And that doesn't mean that we're lending capital to like any company out there, right? Like we have a pretty thorough underwriting process that looks at like your cash balances, looks at like the health of your business and your growth, and really selects the companies that we really believe like are able to pay back in 12 months. But if there's some trouble in between, we're pretty flexible as well.
Awesome. Let's see.
Pete thought that'd be tough to answer.
Well, I thought it might be a longer conversation.
It's a very common one because most of the traditional providers, right? If you look at venture debt, like they'll have not only warrants and covenants, but they'll also have, again, like their recourse and they're pretty stringent. That's where we win every time, because it doesn't mean like the company won't pay or they think they won't pay in 6 months. It's just like the peace of mind that it gives you, that you have flexibility and you don't have a predatory provider in your stack. Like it's just peace of mind for the founder.
Yeah, absolutely.
An interesting thing, and we see this a lot now with fintech and underwriting, like underwriting being almost daily for some companies, is it's their strength and their confidence in their ability to actually accurately predict these. They're taking on the bet that, well, I'm sure you're gonna have somebody who dumps all the money they borrow from Capchase into a really poor bet and it doesn't turn out and you just can't. But like you've got enough customers and things offset that. It also seems quite well.
Absolutely. And like we've seen, if we look at our default rate in our business is incredibly low. Like we've had very few instances where this has happened. And even then, like, with our payment plan, the customer is able to meet it. So, and to your point, if given that we do like pretty often re-underwritings, like we're able to see like how the business progresses and we can try to help before, things get worse. So that's also pretty helpful for the founder.
Awesome. Well, we are out of questions. Thank you so much for being here, Maria. This stuff is super exciting. It's stuff we're looking at as a company. I think it's stuff that it's a really good idea for lots of companies to be looking at. Flexibility is really awesome, and kind of how it compares to all of the traditional options. It's really compelling. So thanks for being here today. We will send around a recording and some show notes with the typed answers to these questions and links to the partnership page. If you do have any additional questions that you just can't think of now, feel free to get in touch with us and we'll put you in touch with Capchase. And thanks to everybody for coming.
Thank you so much for having me, and thank you everybody for attending and learning more about revenue financing.
Thank you so much, Maria.
Have a good one.
Have a good one, everyone.